Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome back to another episode of Through the Noise. My name is Hannah Chu, Portfolio Strategist at Standard Chartered's Chief Investment Office, and I will be your host for today. So in our previous episode, we talked about the importance of the US-China trade talks that just happened last weekend, and we've seen how markets have reacted very positively to the outcome where US and China have come to an agreement to temporarily scale back on reciprocal tariffs. So to help us gain some clarity on market sentiments and how best we can navigate from here, we have Ray Heung, our senior investment strategist. So Ray, welcome back to the podcast. It does seem like markets are coming back from the brink, which I know is the title of our latest weekly market view report. And it is evident that, the US and China trade talks gave prospects to the positive market sentiment over this week, and we've seen the US stocks retesting February's all-time high. So what is next in terms of the US trade policy, and how do you see it affecting markets?
Hey, Hannah, thank you for inviting me back for the podcast. And yes, indeed, the agreement between the US and China has exceeded market expectation and significantly eased the trade tension. I think this clarity factors reduces a major source of volatility in risky assets and increasing the chances of a soft landing for the US economy. And so with these positive sentiment developing, we could see the S&P 500 testing its previous high of around 6,150, particularly driven by the technology, communications, and financial services sectors. We think the positive sentiment will also spill over to China tech, and therefore continue to recommend investors to buy on dips on those sectors. In the coming months, we also expect the US to pursue trade agreements with other allies such as India, South Korea, and Japan. Our core scenario is that the baseline tariff will settle around 10%, which is higher than the 2.4% average from the beginning of the year, but significantly lower than the current levels. We also expect the US will impose higher tariffs to selected sectors, such as semiconductors, autos, and steel. Next focus for the Trump administration, in our view, will be tax cuts. And President Trump wants to go beyond extending the 2017 tax cuts and enact corporate tax cuts to incentivize domestic investment. The aim is to have revenue raised from tariff to fund for tax cuts, and we view that the Trump administration is very concerned on bond yield. They will be very mindful that the tax cut won't lead to higher fiscal deficits, which will have a significant impact to bond yields. Deregulation of the financial and energy sectors also will be among the priorities, and these policies should lend further support to the ongoing equity rally.
Thanks, Ray. And I think you've also mentioned that, we are testing the highs of the S&P 500. So what's really supporting this view?
Thanks, Hannah. I think there's actually both technical and fundamental factors that are supporting this view. And on the technical side, our in-house technical models indicates a bullish trend for the S&P 500 within the next resistance level at around 6,200 level. And also, investor sentiment has normalized after a period of extreme bearishness. And this is definitely a good contrary indicator, suggesting for potential further gains in the index. A caveat, though, however, is that our fear and greed indicators is approaching extreme greed territory at the moment, but we view it more like a brief consolidation in the rally before we are having a new leg higher. On the fundamental side, our favorite sectors are US technology, communications, and financial services. These are benefiting from the easing trade tensions, and they earn significant revenue from exports. And if you look at the first quarter 2025 earnings season, these sectors has continued with their artificial intelligence related spending and demonstrating their confidence in growth. Meanwhile, the financial sector would also get a lift from the focus of easing regulation to boost lending.
Thanks, Ray. And maybe, we've talked a bit about the US stocks, US tech stocks. What about on the China side? China tech, they look like they might be in a good buy on dips opportunity. Maybe you got any color on this that you could provide us with?
Sure. We remain bullish on China tech and also suggest investors to buy China Hang Seng Index, and especially Hang Seng Technology Index on the dip. I think China remains our preferred equity market in Asia. The Hang Seng Technology Index is particularly appealing due to strong AI-driven earnings, very supportive government policy, and also attractive valuations. And our targets for the index in the next month is around 5,900.
Yeah, it does seem that the team does have a bit of a bullish tilt to risk in the current environment. But I guess also in the minds of any investor, what might be some of the risk that we really need to watch out for?
Yeah, in fact, we always need to keep a watchful eye on the economy, and any deterioration in economic data would definitely pose risk to the equities. We have already seen soft business and consumer confidence indicators recently, and while trade tensions have eased, we need to closely monitor hard data like the weekly jobless claim and retail sales. And although inflation grew to a 4-year low, the Fed remains very wary of easing policy too soon on the concern that inflation will rise in the coming months due to high import tariff. However, should data worsen significantly, I think we can expect the Fed to cut rates faster and also the so-called Trump put to come back.
All right. I think maybe let's just switch gears to the Asian currencies. I think we've also seen some action happening there. We've seen the Asian currencies benefiting from the U.S.-China trade truce. Uh, do you think that this could also continue to support currencies like the Aussie dollar?
Yeah, the US and China trade truce has definitely lifted the Aussie dollar as is deemed as a China proxy risk, right? However, I think the dovish monetary policy in Australia is actually acting a counterfactor against significant appreciation versus the greenback. Australia's job market is softening. We are expecting the RBA to cut rates by 25 basis points in the next meeting on next Tuesday. And markets are also pricing in 2 more cuts of the rates by the year end and lower the policy rate to about 3.25%. All these will weigh on the sentiment and also sustain any of the Aussie dollar gains. So our view for Aussie dollar versus the greenback is a range-bound market. And technically, the pair is consolidating around its 200 daily moving average right now. And we expect the pair to trade in the range of 0.613 to 0.694 in the next 3 months.
All right. Okay. Thanks, Ray. I think that was really comprehensive, giving listeners some views on how to expect the markets to move from here on. And I really think that brings us to the end of today's conversation. So thanks, Ray, for joining us today. So maybe just to close off, again, leaving us with some key takeaways from today's conversation. I think number one is that there is expectations for the US to pursue trade deals and shift its focus towards tax cuts and deregulation in the coming months. And I think any substantial progress on trade and deregulation could really take the S&P 500 index above the February all-time high. I think the next point is also that a worsening of economic data could also be the main risk to equity scaling these new highs that we've talked about. So should that happen, the expectation is for maybe the Fed to cut rates and a Trump put on trade, tax cuts and deregulation to be fine-tuned. So we'll leave our listeners with those key takeaways. And we want to thank you, listeners, for joining us in today's conversation with Ray and myself. We hope that you found this very insightful, and we look forward to the next conversation next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.